Welcome to the Balance Sheet, where you rise above the noise and learn about the most important business issues of our age. I'm your host and fellow student, Conrad Chua. Private credit has become a major player, especially in the US and Europe, providing flexible funding where traditional banks sometimes can't. And with more companies turning to or offering these funds for capital, the landscape of lending is changing fast. But this raises new questions. How is private credit different from traditional lending or equity investing? How do private credit funds influence corporate governance, especially in the boardroom, without overstepping boundaries? And why are companies willing to pay the cost for this type of financing? So, we'll break this all down with our expert guest, Professor Narine Lalafaryan, who has written a paper on private credit. Narine is an assistant professor in corporate financial law at the law faculty at the University of Cambridge. She's also a fellow at the Cambridge Endowment for Research in Finance, and will talk about the corporate governance issues that private credit raises. Welcome, Narine.
Hello, everyone, and thank you very much, Conrad, for having me. It's a pleasure to be here today.
So, Narine, could you start by telling us, what is private credit?
Thanks very much. Yes, of course. Well, we're really talking here about non-bank lending. We're talking about sort of essentially non-bank financing, and private credit really, it means many things. And I think we're still trying to understand what private credit is and trying to come up with a precise definition of what is private credit. But as I said, we're really talking about non-bank lenders, specifically private credit funds here, directly lending money to businesses, directly lending money to companies. So there isn't really any intermediation. There are sort of no banks in the middle. And that's one of the reasons why private credit is also called direct lending, because there isn't really any intermediary in between. And I think that while in academic and professional circles, this definition of what private credit is still trying we're still trying to figure out what it is. Direct lending is only one strategy in private credit. It's the dominant strategy at the moment, but other private credit strategies also include asset-based finance, distressed investments, capital solutions, and so on. So private credit also typically involves lending to businesses on a bilateral basis. So companies really rely on private credit for a variety of reasons as well. That could be for instance, acquisition or expansion, or they might also want to just refinance their existing debt, or perhaps to improve their working capital. So for many, many years. And I think what's really interesting is that over the past 16 years, there has been a rise in the private capital generally. So when we talk about private capital, I mean private equity, venture capital, and private credit. But private credit is the fastest growing, or one of the fastest growing sort of asset classes in the universe of alternative investments. And there are different estimates as to how big this market is, ranging from 1.9 trillion to sort of slightly higher numbers. I think it's a bit difficult to precisely figure out what the number is, but the projections are that it's going to grow even more and more.
So, Narine, what's been behind this recent rapid growth of private credit?
Mm-hmm. Could I just start by answering your question by saying that private credit is not really a new phenomenon? I think this is something really interesting. We see a lot of headlines saying, the new force in finance or the golden moment in private credit. It's a new thing. I think that, first of all, it's not really new. This asset class existed even before the 2007 and 2008 financial crisis. But it has really rapidly grown over the past years. And there are a couple of reasons for this, as you asked me. I think the first one is that there is nowadays more corporate debt than we had before. So, from a supply-demand perspective, companies require more debt for a variety of reasons, whether it's, again, for their working capital expenditures, refinancing, leveraged buyouts, or other things. The other thing is there were liquidity issues in the past years. So if you look at the time frame of 2022 to 23, the broadly syndicated loan markets, they were largely frozen. And this also gave an opportunity to private credit funds to fill in the gaps in the market where the syndicated loan market couldn't really help the companies. But probably one of the large drivers of private credit and that it's growing so fast is the market changes and the regulatory changes. And one might argue that private credit has started growing, especially after GFC and especially after COVID, and when syndicated loan markets were almost frozen. But I think the story really goes back to 1970s. In 1970s, the traditional bank markets, it was a very sort of relational finance-based market where the lenders and the borrowers, they knew each other. So the banks were lending on a relational basis. There wasn't a lot of information asymmetry between different parties. But things started to gradually change. And obviously, after the global financial crisis of 2007, there was more regulation introduced as a response to what happened during the GFC. So the Basel III framework, for instance, the Dodd-Frank Act in the US, banks have to comply with its capital adequacy rules. So regulation prompted also the rise in private credit because banks, they're banks, so they have to comply with these rules and they can no longer do what they used to do. And someone has to come in and fill in the gap and help these middle market companies to get financing. And this is really where private credit funds stepped in. And over the past 16 years, these private credit funds existed, but they were building more and more experience. And they are now in a very sort of strong position also to compete with banks. If I may address this part as well, private credit was originally seen as a sort of, debt finance providers to sort of small and medium-sized companies and, types of companies that traditionally were not able to go and get debt financing from banks. But now they are actually competing with banks as well. So there's quite a lot of increased competition, but also partnership between private credit funds and the banks. I think another reason for growth of private credit is that, well, of course, debt offers very attractive nominal returns to their debt investors in the moment because, the interest rates were quite high over the past years. And for a while, Bank of England, the interest rate was 5.25 for a long time. And it was only recently that the interest rate was cut down. But it really gives private credit funds a good opportunity to generate return for their investors. And so investors are also interested in investing in private credit. I think the next review for the interest rate is on 7th of November. So we will see whether Bank of England and the counterparties in the US and in Europe, whether they're going to cut down their interest rates accordingly. And for me, the final factor, there are many factors for why private credit is really growing, rapidly growing. But for me, what I find interesting is also the growth of hybrid funds. And these hybrid funds, they originated probably as a response to COVID. So what was happening is that for years in the private capital industry, opportunities didn't always match the capital that the funds had raised. There was a mismatch. And during COVID, obviously, because of the changing market situation, the conditions, this mismatch was really aggravated. And hybrid funds stepped in. So they're, multi-strategy funds, or they're also known as pod shops. They don't really have an equity or debt strategy. It's all about flexible solutions to companies. And I think with the arrival of these hybrid funds, because they solved this issue of the mismatch, more and more investors became interested in investing in private credit due to the flexibility that the hybrid funds are offering. So there are many factors, but I think I will stick to this ones.
Yeah. So you mentioned how in the wake of the global financial crisis, there was a lot more regulation of banks, the traditional banks, when regulators saw the kind of systemic risks that banks had built up. So are private credit funds regulated, or is it much lighter in regulation?
Mm-hmm. Mm-hmm. No, that's a great question. And because the private credit industry is really flourishing, there is a lot of discussion, both in practice and in academia, about regulation, about the extent of regulation, and whether if we regulate it too much, we're going to over-regulate it. Let me start by saying that they're not regulated in the same way as banks are. And the simple answer for this question is because they're not banks. Banks have to comply with banking regulation, as I mentioned, the Basel III framework, and from time to time there are sort of certain updates to this framework, and banks are operating in a different way from funds. So there is expectation that we're going to regulate them, and banks also play a different role in the society from the funds. There is a very sort of big societal component to what banks are doing. So compared to this, private credit funds, they are regulated, but they're regulated as asset managers, right? So it's not the same. But however, at the moment, there is a lot of discussion about whether they should be regulated. For instance, if there is a retail market now originating, and there is a discussion whether we should sort of allow retail investors to be involved in this industry, we need to have more transparency, and we need to understand better what's happening in this market. But the short answer is they're not regulated in the same way as banks are, and they are regulated as asset managers. So they do have disclosure obligations, but it's not the same as banks, because banks just play a very different role. And whatever kind of potential regulation comes in the future, it's not going to be the same type of regulation as the one for banks, just because we're talking about different types of, it's a different phenomenon.
And can you give us just an idea of who are some of these sophisticated private credit funds?
Yes, of course. As you know, in any industry, I think we have sophisticated investors and non-sophisticated investors. And I think the sophisticated investors will be those private credit funds that were in the industry even before the global financial crisis. Many of them started in early 2000s, some of them actually before this. And they have an experience of handling certain issues during the GFC, during COVID. So, when there were very sort of economically important times, they learned how to sort of navigate through this uncertain time. So those will be sophisticated investors. I can just mention just a couple of names. Private credit funds such as Ares, Blackstone, Oaktree Capital, and Apollo, for instance, KKR. But of course, there will also be new market participants, and as this industry is booming, there is more interest from the investor side, and more funds are. We're seeing new names, especially during COVID and after COVID. And these investors are not as sophisticated as the sophisticated funds that were operating for more than 16 or 20 years. But also this affects the types of the deals that they're doing. So also the size of the deals. The more sophisticated investors are now really often lending to not just middle market companies, but to investment grade companies, even public companies, which is very interesting if you think about it, because private credit originally, when we think about it, we think about smaller companies, the ones that are not in a position to get bank financing. But the sophisticated private credit funds, they really work with sort of bigger companies, investment grade borrowers, and they lend financing in sort of bigger, what we call club deal format, where several sophisticated private credit funds get together. And obviously the size, the ticket size is much bigger, because we're talking about not just millions, but billions. So I think that's the difference really between sophisticated investors and non-sophisticated, and also how they, the valuation issues, and whether they are able to foresee the risk and the quality of the financing that they're providing, the terms that they're bargaining for. I think if the investor is a sophisticated investor, obviously this is going to affect a lot the relationship between the private credit fund and the business company in which they're injecting that capital.
And how do private credit investors sit in the capital structure versus, say, a traditional bank loan lender or equity investor?
Mm-hmm. It's a good question. There isn't really one size fits all approach to this. So it would very much depend on what private credit strategy we're talking about. It will also depend on the business that's in which the private credit fund is injecting that capital. In the majority of cases, as we're talking about direct lending strategy, which is, as I said, one of the private credit strategies, typically, this will be sitting somewhere in the sort of higher part of the capital structure. So this will be senior secured loans, and this debt investors are quite sophisticated. Obviously, if from sort of the business's point of view, if it's a senior secured loan, it means that the interest rate is not going to be very high, because the lenders are more or less sort of sure about the company's profitability and profile. But senior secured loans are not the only example. And I just want to say that many years ago, senior secured position in the capital structure was more common for traditional bank financing. And this is really an interesting change that we're seeing. So for direct lending strategy, this is very common. We also see investments in the sort of in-between capital structure. So if we talk about unitranche loans or mezzanine financing, that's also something that funds are interested in. But again, this will very much depend on the business in which the funds are injecting that capital. On the equity side, I would say private credit funds are not only they don't provide equity financing. What they do is they often couple their debt financing with there is an equity component to their debt financing. For instance, they might provide a loan to a company and it's debt essentially with a warrant. So it's a convertible debt. So there is this equity component there. But we also see, and it's something that's more of a common and modern market trend, is making a debt investment and at the same time investing in golden shares. And golden shares are activated upon insolvency. So there are no economic rights attached to them. They're control rights. So to answer the question short, there is an equity component, but they don't just invest in shares. So they don't sort of just do equity financing. It's typically debt financing with some kind of equity component.
And you come from the law faculty, so you're very interested in the corporate governance side of things. What are some corporate governance issues that private credit might raise?
Thanks very much for this question. I really like this question because, and I wrote a paper as you might know, sort of private credit, a renaissance in corporate finance. And what I find what I discuss in this paper, and what I find from my research point of view very interesting, with the rise of this private credit as a phenomenon, is how evolution of corporate finance, how the changes in the corporate finance markets, how they affect the discussion that we have about corporate governance and the discussion that we have about corporate control. What I find interesting is how these funds they are sophisticated investors, so they know what they're doing. And depending on a private credit strategy, of course, they will be bargaining for some control rights, some influence rights. It's not entirely uncommon for private credit funds, for instance, when they inject debt capital in the companies, to bargain for board observer rights or nominee rights. Some of them might even bargain for board representation. My understanding is that it very much depends on how big is the debt investment. If it's a large investment in the company, then obviously the lenders will have sort of more bargaining power to ask for this. So there is an influence on the board as well. They quite often appoint their own directors on the board of the companies. And this is really interesting because in traditional bank financing, this is not entirely uncommon, but for many years, typically banks were appointing someone on the board of the companies to which they were lending debt financing, typically when there was an issue of distress. And for many, many years, banks were very careful not to actively be involved in the governance of the companies in which they were providing debt financing, because they don't want to overstep, and because we're in the UK, I think, and sort of English law is, we have the English law legal system here, at least in England and Wales. We have this very interesting concept of shadow directorship, which essentially means that if you're sort of overstepping as a lender, you might be labeled as a shadow director. And if you're a shadow director, then there's certain rules, fiduciary duties specifically, that will apply to your director's duties, which you owe to the company. So banks were very careful about this. And Nowadays, funds, they appoint their own, sometimes also independent directors, sometimes, as I said, board observers, sometimes they just ask for board representation. So for those that are appointed by the funds, I think it's very interesting, the question, what happens if there are potential conflicts of interest between the company on whose board they're sitting and the investors who appointed them. And this is a very interesting question in practice. And I think lawyers in practice are really aware of this issue. It's a huge, important issue, and they're helping their clients to very carefully navigate this issue, not to overstep. And when these issues arise, the directors might recuse themselves or resign from the board in order not to breach their director's duties. So there is this sort of interesting element of influencing the board, whether it's for formal meetings or informal meetings. And if we're thinking about the direct lending strategy, conflict of interest is less of an issue here. But if it's a distressed investment, and it depends on a type of a distressed investor, we need to differentiate between private credit funds and vulture funds, who are also investing in the sort of distressed companies. There might be very interesting conflict of interest issues, and the directors, if they're appointed on those boards, they have to be very, very careful and make sure that they navigate through this correctly in order not to breach their director's duties. From a governance point of view, another point that I think it's very interesting is because private credit funds, it's an illiquid market, typically illiquid. So when they provide money to companies, they're stuck in a relationship. It's a long-term investment. They're investing in a company for a long time, I don't know, maybe 8 years, for instance, or 10 years, could be even longer. And they typically cannot exit this relationship. And that's the reason why they also charge an illiquidity premium. But this means that the way they engage with the borrower companies is rather different from the banks, because they have this sort of relational element. So relational finance, I think, is actually back. Banks cannot really do this anymore, and the reason for this is, again, because of the regulation. They have to comply with the capital adequacy rules, and banks typically in the modern market, they operate in this what we call originate to distribute to the secondary loan market model. So they originate the debt and then they sell it to the secondary liquid loan market. And this means that their influence and interests in the company are limited to the time when they are actually holding the debt before they offload it. And their involvement from a corporate governance point of view is going to be limited to the extent also, as long as it has to be the covenant framework, it has to be good enough for someone else in the secondary market to be, interested to buy this product. So they can't really engage in relational finance anymore. And this is, from a governance point of view, I think, quite interesting. And when I say governance, I don't only mean positive governance. I think when we talk about corporate governance, and here specifically debt governance, you can have both positive debt governance and negative debt governance, and that very much depends on what your debt provider, what their objectives are when they're lending this money. So I think that's another interesting sort of development in the markets, that relational finance is really back. From a governance point of view, what I find also quite interesting is that private credit funds, they typically bargain for a more bespoke covenant package when they provide financing to companies. Maintenance covenants are always included, at least 2 maintenance covenants. When we compare with bank financing, I think the trend is coming back, but the past 5 years or 6 years, there was increasingly this phenomenon of covenant light financing, where the maintenance covenants were not the package of the covenants was not the same as sort of more bespoke package. The one also including the one that included also maintenance covenants. So I think in terms of covenants, this is also quite interesting. And just the starting point also, typically bank financing is based on standard documentation. So when the negotiations start, we typically start with a standard documentation, which is very, very helpful. And then it, depending on the type of the deal and what the sort of parties to the transaction want to achieve, of course, the lawyers will spend a lot of time negotiating more concrete provisions. In private credit, my impression is that there isn't really standardized documentation. And this is really what's interesting from a governance point of view. There isn't really one size fits all approach to governance. How lenders are, what are they bargaining for, and how are they bargaining for? So this is very interesting. And again, it's very project specific, business specific, industry specific, the type of the documentation that we see. I think I'll stop here.
Yeah, we've got a couple of questions actually. So the two questions, well, maybe the first one is a comment from Michael, who says,
Hi, Michael.
These enhanced governance rights, they give rise to shadow director concerns where the rights don't actually extend to the board representatives. And he also wanted to clarify what do you mean by negative governance? Does that mean veto rights restrictions? So, Narine, if you can
I'm very happy to
address those points. Well, I guess if you could also add a bit of color to what happens in the boardroom when you've got these private credit appointed directors who may be coming very close to what's possible. How do the rest of the board respond in those sort of situations?
Yeah, I mean, all questions are very interesting. I think I will. It's easy to answer the part about negative governance. Thank you very much, Michael. It's a very, very interesting point. When I say negative governance, I mean if, for instance, it's and as I said, we need to differentiate in the context of distressed investments between private credit funds and vulture funds. But depending on what the investor wants, they might actually engage in a type of a governance that is beneficial for the investors, but it's not really good for the company in which they've injected that capital. They are really sort of putting the company into pieces. This is what I mean. It's an example of when I mean negative governance. The positive debt governance will be when this debt investors, they actually add value to the company. They help the company to develop and grow. And I agree with you. I think in terms of board representation issues, this gives very interesting questions to shadow directorship and de facto directorship. And these concerns are real. And I think this is where lawyers, colleagues in practice play a very important role, solicitors who help their clients to better understand how they can exercise governance, add value to the company, but not to overstep sort of, where is really the line. And I think if it's a direct lending strategy, this is less of an issue because overall, the lenders are interested in adding value to the company. In the context of distressed investments, I can see how this is potentially more problematic because there might be a conflict of interest between what's best for the company and what's best for the investors. But at the same time, if you're sitting on the board of the company, then you owe your duties to the company and not to the investors that have appointed you. Konrad, I'm very sorry. I think I forgot the question that you asked me. Would you mind reminding me about it?
Yeah, so what happens in a boardroom when you've got board of directors who have been appointed by a private credit fund and they start to move very close to the boundaries of what's acceptable, and as you say, start to represent interest that's not quite with the company? How do the other board of directors respond, or how should they respond?
That's a very good point. So my understanding is that first of all, if there is a conflict of interest, these directors will recuse themselves or they will resign. So in order to avoid breaching their director's duties, this is a really serious issue. If they have lawyers also who are advising them, they will be warned about this. And from the side of the funds, I think this concept of shadow directorship and de facto directorship, but specifically shadow directorship, this is something that's actually quite unique to England and Wales and English law. For instance, the funds, they operate globally, they operate internationally, and some of the US funds might actually invest here. And of course, it very much depends on how sophisticated they are and the lawyers who are advising them. But it might very well happen that they're not aware of the shadow directorship issue. And this is really interesting. So from an academic and research point of view, I find this question very interesting. What happens in the boardroom, as I said, they will either recuse themselves or they will resign. But if I can sort of connect that question that you're asking me to another point, is not all the investors have appointment rights. And sophisticated investors such as private credit funds, they will have that. So not all shareholders and not all creditors can appoint someone on the board. And I think this mismatch or sort of the asymmetry in power is also very interesting, and it creates conflicts within different types of capital providers in a firm. And there's also quite a lot of information asymmetry between the directors who've been appointed and who appointed them. And so I think it's really interesting, this part as well.
We have two questions from Assad. So Assad, I think, is referring to what you mentioned about warrants leading with golden shares. Mm-hmm. So he asks, does this mean that the private credit lender could potentially take over an insolvent company and act like a private equity investor?
Mm-hmm. That's a very, very, very interesting question. In the context of distressed investments, I think, as I mentioned, it's very, very important to differentiate different types of distressed investments. So, vulture funds have different strategy. Private credit funds, especially sophisticated ones, will be interested in loan-to-own strategies. They will be interested in owning equity, actually. So, yes, in principle, they can take over the insolvent company. For instance, if it's debt converting to equity, or if it's debt and golden shares, and those golden shares will be activated upon insolvency. That's what they do. And when they inject debt financing into these types of companies, they will have a conversation with the company, and they will tell these companies that this is the reason why they're injecting the capital. So if the company does well, this debt financing that they have provided will save them, and it's a win-win both for the fund and also the company. But if the company doesn't do well, they disclose this from the beginning, that they will be taking over the company. Now, I can see how certain stakeholders within the company, for instance, other creditors or minority shareholders, might not necessarily be happy about this. But these investors are disclosing this from the beginning. And again, we need to bear in mind, what kind of investor are we talking about? Are we talking about a vulture fund? Are we talking about a private credit fund? Because my understanding is that the way they engage with companies are not necessarily the same. So the short answer to Assad's question is yes, they come as debt investors and then they become equity.
Assad has a second question is, why are investment grade companies opting to go for private credit when they could get better terms from traditional banks? What's making them pay that extra spread?
Very interesting question. I've been asking myself this question for a while in the context of my research. As private credit market started as a market to, middle and small and middle market companies, especially middle market companies. But we're seeing now increasingly interest from investment grade borrowers to opt for private lending. I think there are various reasons for this. First of all, the speed, the extra speed to borrow privately, as Assad is mentioning. Also confidentiality. It's a very non-transparent framework, which is, from the borrower's perspective, probably interesting. Overall, it would be beneficial, I think, for us to sort of see more what's happening in this market and more transparency, to have more disclosure. But this is something that the borrowers might really like. Depending on the type of the business and the industry in which these companies are operating, private credit funds might also offer specialized knowledge in that specific industry. So they might bring their own people who have experience and knowledge of running this kind of businesses, and relational finance. This is the point that I mentioned. I think from a corporate governance point of view, it's a game changer, because you, as a borrower company, and you trust to an extent the lenders who are going to own your debt, compared to bank financing, where you might be in a very good relationship with your current lender, but once they sell it to the secondary loan market, you don't really know who's going to buy it. So I'm not saying that there are not advantages to bank financing, but I think from a borrower's point of view, this might be an issue. And just to give a couple of examples, last year, a couple of multinational public companies, such as AT&T, Air France, Wolfspit Incorporation, they went for private credit as opposed to bank financing. Another potential reason might be that, 2022-23 syndicated loan markets were largely frozen. So maybe that also explains to an extent why some of the investment grade borrowers, opted for private credit. But private credit also can put together these club deals and come up with really sort of bespoke documentation, very sort of tailored solutions to the problem. So I think it's really about trying to balance what are the benefits and the costs in both types of financing and see what's best for you.
A question on LinkedIn about transparency in the boardroom. Right? Do you think technologies such as blockchain, AI could help enhance transparency in such situations, or is there something else that could help?
Sure. No, this is a really interesting question. I think my understanding is that while this industry is very well aware of the technological advancements, at the moment, many of these sort of AI solutions, they are being tested in this industry, but they're not being really implemented. And one of the reasons for this is because the market is a non-transparent market, and you don't really know whether AI will have sort of access to certain very confidential information. I do see the benefit of it, but I also see why sort of from investors' point of view, they see the risks. So I think again, and in my impression is it's also sort of a bit too early to implement this. There's some basic things that the funds are relying on from sort of this AI tools, but it's not as influential at the moment, and they're not using it a lot to influence corporate governance in the companies.
Christopher from New York asked, is there a way to package green infrastructure, net zero climate transition projects for financing through something like private credit?
I think private credit generally is, as an industry, is and all the business industries at the moment, climate change and green financing, it's a very important challenge for all of us. And if you want to stay in the market and if you want to be competitive, you need to think about these solutions. And environmental social governance is very important for banks, but also for private credit funds. And again, if you try to connect it to the governance side of the story, one might argue and say that private credit funds are in a better position to do this compared to banks, because again, it's a long-term relationship, it's an illiquid market, and there is more opportunity and scope for influence. So, green financing, for instance, might work much better in this context than if it's a liquid market. But I think again, ECJ is one of the factors where private credit funds are very aware of this, and they're incorporating this into the documentation, also the deals that they're working on. But it's a dynamic, evolvement. So I'm not sure if I can sort of comment on this issue in more detail than what I've already said.
Ahmed asks, what happens to the private credit market when interest rates go down? Is this a temporary thing?
Yeah, that's a very good question. My very short, honest answer is I don't really know. We'll see how it goes. At the same time, very high interest rates were, on the one hand, good for private credit funds because they were generating high returns for their investors. But they also, the higher the interest rate, the flip side is that servicing cost of debt for the companies in which they were injecting that capital is becoming more expensive. So I think from the fund's point of view, they would like an interest rate that's high, but it's not very high, so the companies cannot. Companies are, in a better position to pay back this debt. So there was a boom in private credit, especially last year, and my impression is that the market has slowed down a bit because the interest rates are going down. But at the same time, investors, sort of the funds, specifically private credit funds, they have become very sophisticated, and they're thinking about ways how to address this issue. So I think private credit will not go away because interest rates go down, but it might not grow as fast and as rapidly as we saw in the past 2 or 3 years.
And Narine, you also work at the business school, and here in this business school, as with all other business schools around the world, we teach corporate finance largely from a very technical perspective. So we teach students how to calculate weighted average cost of capital, what the risk premium might be. But from what you've shared, it sounds like corporate finance is much more than that. It can also play a role in the boardroom. It could influence a company's strategic direction. So what's your advice to our business school students who are learning corporate finance right now? How should they be thinking not just about the technical side, but also larger issues like corporate governance and strategy from corporate finance?
Yeah, it's a very interesting question, and I think this is relevant for business school. This is relevant for lawyers as well who are learning corporate finance law. Corporate finance has changed a lot. That's the sort of the key message. Over the past 60 years, there's this sort of a dynamic redesign of corporate finance. Different things are affecting it. What I find very interesting, and the reason why I was doing given this research in this area is private credit is an interesting phenomenon. It's a relatively new thing. Everyone is talking about it. But for me, what was very interesting is to understand this link between corporate finance and corporate governance. And this link, at least in academic circles, is not really explored a lot. There is a lot of discussion in corporate governance about equity governance and debt governance, and less so discussion of the intertwined equity debt governance. And when you compare it with corporate finance, the foundational corporate finance theory is, Modigliani-Miller theorem, and how equity debt, ratio is very, how the two are connected. And I think for me, the interesting development is to understand better how corporate finance is influenced in corporate governance, how the changes in the corporate finance, how the changes in companies' capital structure, how the changes in the equity to debt ratio. These are not just corporate finance issues. These are issues about corporate control, and more specifically, the fight for corporate control. Are we talking about shareholders? Are we talking about creditors? What if it's neither really equity nor really debt? It's an instrument that's somewhere in the middle. It's a blurred instrument. That's actually a new project that I'm working on at the moment. It's called Chameleon Capital, and how these changes in capital structure, how they influence corporate control. So we can think about these questions from a broader point of view and think about how corporate finance is really connected to many different areas, and sort of corporate governance and corporate finance are really two areas that are very much interconnected, and one might influence the other one.
Thank you so much, Narine, for showing us how private credit is reshaping finance. I also hope our business school students will look at corporate finance in a different way after today. And thank you to our viewers. The balance sheet will be back next week, 1st of November, 12:45 UK time, where Professor Yusuke Ikegama, an alum of Cambridge Judge Business School and now head of Waseda Business School, will talk about Japan's corporate comeback. So till then, stay well, and we'll see you